Hello, welcome back. Well done for sticking with it. We're on to the final lecture in this chapter 6, and it's a fairly short one. We're looking at meetings and resolutions. Now, this is where most of the shareholders' rights will be exercised. This is where all the interesting, juicy discussions will take place. So, we need to have a look at the rules. First of all, there are two sorts of meetings to think about. There is a general meeting and an annual general meeting, and they are different. Only a PLC needs to hold an annual general meeting, whereas both a PLC and a limited company, a private company, will hold a general meeting. Now, the Companies Act provides fairly detailed rules about when and how a meeting will be held and how a meeting will proceed once it's on its way. Now, you need to know these rules, unfortunately. They are quite dull, but try to learn them. Any question in the exam is likely to be a very straightforward, what is the notice period for a general meeting? What is the notice period for an annual general meeting? Something like that. What percentage of votes is needed to pass a special resolution? So, nothing too onerous, but unfortunately quite a bit of rote learning. So let's look at general meetings first. This is the meetings that any company might hold, a PLC or a limited private company. Who calls it? Well, normally it's the company directors, so they might ask the company secretary, if they have one, to schedule the meeting for them. But they initiate it because they know a meeting is needed. Could also be shareholders. Remember, if you've got more than 5% of the share capital in a company, you can call for a meeting as well. Then there are a couple of other groups who have the right to call a meeting. An auditor, the company auditor. He's only really going to call a meeting if something's very wrong, and generally that's because he's about to resign. Now, if an auditor resigns, he has to give what we call a statement of circumstances about the meeting. And this is usually just a written statement that says, I've resigned, there's nothing to worry about, everything's fine, it's just that the company has outgrown my firm, for instance. Or I have become too expensive for the company. That's okay. But if he can't give a statement of circumstances, if he's worried about something, he has to disclose it. And a copy of that statement of circumstances will be given to all of the shareholders. And the auditor at that point can request a meeting where he can explain what's going on. The court may also call a meeting on occasion, either on its own motion, perhaps following insolvency or a report by the Department of Business Innovation, or possibly because a shareholder has applied to the court in response to the company's failure to respond to the shareholder's request for a meeting. So what is the proceedings then for this meeting? Well, they must give 14 days clear notice to the shareholders. Now, when I say clear notice, that means you exclude the day the notice is given and also the day of the meeting. So you need 14 clear days in between that. Also, if you serve your notice by post, you allow 48 hours for post. You give notice to all shareholders and directors who have an address for service in the UK. And the idea of this notice is that you have to give the shareholder enough information for them to decide whether or not they want to come to this meeting. And if they do want to come, they need to be able to find it to get there. So practical details like the time, the place, and details of the business they're going to cover. If any special resolutions are to be debated at that meeting, you need to give the full text of this proposed special resolution. If shareholders are calling the meeting, then they need to give the directors notice that they wish to hold a meeting, and the directors have 21 days from receiving that notice to call the meeting, and the meeting must be held within 28 days. So basically that meeting could be, 7 weeks away when the shareholder serves his notice. A final point there, we call it a PLC in crisis, but there is a rule in statute that says if the assets of a PLC fall to half of its called up share capital, the PLC must declare a meeting. It must hold a general meeting to discuss what action is going to be taken. Now, just another point to note, short notice. We've said that the directors of the meeting have to give 14 days clear notice to the shareholders. Now, sometimes that may be quite inconvenient if something urgent has come up which needs the shareholders' approval. Now, if the shareholders agree, then we can consent to a meeting at short notice. The problem with this is it's different percentages depending whether the company is a private company or a limited company. So for a private company, 90% of the shareholders must agree to the meeting going ahead at short notice. If it's a PLC, remember the rules are always a little bit stricter for a PLC, 95% of the shareholders must agree. Now, quite often if it's an owner-managed business, that's just not a problem. Everybody's quite happy to consent to short notice. But if it's a big PLC, getting 95% of the shareholders to agree, well, you can pretty much forget it. It will be too difficult. Now, an annual general meeting is something that's held by a public company. And the statute says they must hold an AGM in each financial year. The meeting must be within 6 months after the accounting reference date. Now that kind of makes sense, doesn't it? You're not learning a new date there because you already know that the accounts from a PLC must be approved by the shareholders and they must be filed with company registrar no more than 6 months from the end of the accounting reference date. So it wouldn't make sense if your annual general meeting was after that date. However, if you don't hold an annual general meeting, then that could result in a fine for the company and also for the officers. Now, the annual general meeting is a bigger deal. The meeting must have 21 days notice. But if all the shareholders this time agree, then we can consent to short notice. So when we're looking at short notice, what we're looking at, we can sort of lay it out in a little hierarchy, which makes it easier to learn. If it's an AGM, we need 100% of the shareholders to agree. If it is a general meeting, depends. If it's a PLC, 95%, and if it is a private company, 90%. If you lay it out in that sort of table, it's a little bit easier to remember those percentages because it's more logical. We know an AGM is the most important, and we know that PLCs are more tightly regulated than limited companies. Now, what happens at your annual general meeting? Well, this is where you might appoint directors. And if the directors have to retire on rotation, which is quite often the case under the corporate governance rules and also under the standard articles, this is where they'll be reappointed. Appointment of the company auditors, which you'll remember for a PLC, has to be done annually. This is where the accounts will be approved and also that annual dividend will also be agreed. It's the directors who recommend the dividend and the shareholders who get to approve it. Now, any other business that's conducted at the AGM, and anything else that's relevant can be discussed at the AGM. But if it's not routine business, you must provide details of that in the notice of the meeting. Now, decisions at the meeting. It depends on what you're trying to achieve. The majority of the business of the company will be achieved by ordinary resolution. Now, an ordinary resolution requires more than 50% of the votes. So we tend to say 50% of the votes plus 1. Okay? A special resolution applies to certain aspects that are perhaps more to do with changing the company's constitution. And there's a list there of provisions: changing the company's name, altering the company's articles, reducing the share capital, winding up the company. These are all fairly important things. They are constitutional changes and they require more than or equal to 75% of the votes. Notice the equal to there. So that's a special resolution. Now, in order for a special resolution, well, for any resolution to be passed, we're looking at this required percentage of votes, but that is the percentage of votes who attend the meeting and who vote. So if you don't go to the meeting, or if you go and decide to abstain, your vote doesn't count. It's only a percentage of the votes cast. So you could be in a position where a special resolution is passed by more than 75% of the people who attended the meeting and cast a vote. But actually, that percentage is actually maybe only 10% of the votes. It's a bit like electing a government, really. Now, if you do pass a special resolution, that resolution is filed with the company registrar within 15 days. We've already seen that deadline. It's not new. Now, anything which can be done by ordinary or special resolution, with 2 key exceptions, can also be done by written resolution if you are a private company. Now, this means that a private company doesn't actually have to bother about having a meeting at any time. It can do all its business, bar these 2 points I'm about to mention, in writing. And what happens is the company will draw up the resolution that it requires to be approved by its shareholders and send it out to its shareholders, either by post or by email. And with that written resolution will be instructions on how to vote. And each shareholder will receive that resolution and will cast their vote. As soon as they've cast their vote, which must be within 28 days of the resolution being sent out, then that vote will count. You can't then change your mind, even if it's before the deadline. It doesn't matter. Once you've cast your vote, it counts. And as soon as the resolution has the required percentage, either 50% or 75%, depending what you're trying to do, then it will become passed by the company. Now, there is a slight difference here because we mentioned you could pass an ordinary or special resolution with a relatively small proportion of the votes. But a written resolution, because it goes to all of the shareholders, will require literally 50% for an ordinary resolution or 75% of the votes of the shareholders, to vote for a special resolution. So you do need to have the correct majority if you're using the written resolution route. Now, I said there's 2 things you can't do using a written resolution, and we've seen these already. The removal of a director or the removal of an auditor. Both of these things happen at a meeting using special notice. And that, remember, is because the director or the auditor have the right to make a statement to explain themselves and to try and defend themselves. So we must hold a meeting if we're trying to remove a director or an auditor. Now, we've already said if we're going to remove a director or auditor, we need an ordinary resolution, which is more than 50% of the votes, on special notice. And just for completion, I've put that at the bottom of the table there. So if we want to remove a director or an auditor, we must give 28 days notice of the meeting. Okay? Again, learning that table will be quite important if you can manage it. Now, what happens when you're actually at the meeting? Well, a meeting, in order to proceed, must be quorate. Now, to be quorate, it means it must have the right number of people present, and that's normally in the articles. But if the articles don't say, we're looking at a minimum of 2 shareholders. Now, the problem with that is if you've only got 1 shareholder, and obviously in that case, if you only have 1 shareholder, then you don't need 2 to have a meeting. We'll look at sole companies in a second. Now, how are those votes cast? Well, initially, we use a show of hands. So literally, everybody who's present will get 1 vote, regardless of how many shares they own. So 1 shareholder, usually one who's got quite a significant number of shares, might say, well, actually, I want a poll vote. And a poll vote is where we count each share as 1 vote. So if you own 100 shares and somebody else owns only 10, you will get 100 votes, he will only get 10. Whereas on a show of hands, you would have had 1 each. The meeting, you must keep records of your meeting for 10 years, and they must be available for shareholders to inspect at the company's registered office. So we're looking at the minutes of the meeting and also the resolutions. Remembering, of course, that certain resolutions which affect the constitution of the company will already have been filed with the company registrar. Now, some companies may have different classes of shares. You may have, for instance, ordinary shares and preference shares. Now, if that is the case, you have 2 classes of shares. You may have ordinary shares, A, Bs and Cs, in which case you've got 3 classes of ordinary shares, all with slightly different rights. Now, if that's the case, then it may be appropriate sometimes to hold share class meetings. So a meeting may be of the ordinary shareholders, but not of the preference shareholders. Quite often this happens when a company becomes insolvent, and the insolvency practitioner will meet with the different shareholders in different days just to discuss the points that are pertinent to them. But in general, the rules applying to each class of share, to each class meeting will be exactly the same as the rules that apply to the shareholders' meetings in general. Now, if you have only one shareholder, you might think you don't really need shareholders' meetings, and that, to an extent, is true. So a single shareholder doesn't need to have meetings, doesn't need to send notice of meetings with himself. That would be fairly stupid. However, the legislation does provide that he needs to take a written record of a decision, as if he'd had a meeting. So a sort of record of his own deliberations, of his own reasoning, and he must file them in just the same way that a company with multiple shareholders would need to. So almost as if he has a little discussion with himself, records the key points and keeps that record. Okay, that brings us to the end of chapter 6. It is a long chapter, I agree, and there is a lot in it, and it is quite dull and hard to learn. The best thing to do is as many questions as you can. Okay, and I wish you the best of luck in learning that. We still have a little bit more to go on companies, but it's slightly different material that we need to look at in the next chapter.